Hello and welcome to another episode of The Index Investor. Today we're talking about something that often looks small but makes a huge difference over time: costs. Specifically, how the cost efficiency of index funds can translate into better outcomes for investors. And joining me today are Mohit Beriwala. He's founder of Shri Rama Managers, and Pranit Mathur. He's mutual fund analyst at Value Research. And while Mohit brings a practitioner's perspective on fund management and investor behavior, Pranit will help us understand the data and research behind why lower fees often mean higher returns. Welcome, gentlemen.
Thank you so much. Thank you for having me.
Great to have you here. Let's dive right in. And Mohit, I'll begin with you. When we say investment costs, what exactly are we talking about, and why do they matter so much for long term investors?
Let me give you my CFA ka background and what I something I learned. And my intuitive sense is there are three obvious costs. First is taxation.
Mhm.
Ideally, we see this at the end of every advance tax payment or at the end of the year, jab AIR aata hai, and we see crazy amount of taxes to be paid. That is the obvious cost. Second is the financial advisory cost whatsoever, whether it is through distributor commissions or through advisory fees, whatever it is we are paying to our advisor for that advising us. And third is the investment manager cost, which I would call it the fund manager expenses before the advisory commission is being added, fees is there. So that are the three obvious costs. This is my sense of the investment cost. The fourth cost, which is not obvious, is basically behavioral cost. I'm giving an example. I'm sure everybody sees this, but last year everybody wanted to buy small cap funds. This year, during attacks of India and Pakistan, everybody wanted to buy defense fund, and now we want to buy crypto and gold and silver. It is about the behavioral cost of doing what is not right, but doing what is in vogue. So there are four investment costs, as per my understanding.
Right. Pranit, we often hear that even small fees can eat into returns over time. So, can you explain how compounding turns these tiny costs into a big drag on wealth over time?
Absolutely. So it's one of those things that seem almost too trivial to matter in the first hand. The average active equity or a hybrid fund per se charges around 0.8% as the expense ratio. So even a half a percent here or there or 1% there shouldn't really matter much in the long term, right? But that is what people try to misunderstand in the longer run. What people understand is that power of compounding ensure that your long-term returns increase over time and increasing your portfolio therein. However, the costs also come into play here. So think of it this way: when your money compounds, your returns earn more returns. But like expense ratios, on the other hand, beat the cost, do the exact opposite of it. They eat into your corpus period over a period, and every rupee lost to fees not only disappears the corpus today, but it also helps you protect, sort of stops the long-term return that you could have earned in the future. So take a simple example for this. Suppose you invest 10 lakh rupees for 25 years in a mutual fund, and then your fund earns about 12% annually before costs. And assuming that your fund costs about 0.5%, your effective return would eventually drop down to about 11.5%. Now that half a percent, while seemingly minuscule in nature, over 25 years, your final corpus pre-cost would have been turned out to about 1.7 crores. However, post-cost, that amount would have come down to 1.52 crores. So that's roughly 18 lakhs of the entire corpus that was gone into the wind purely because of costs. And that 18 lakhs, for context, is about 10 or maybe 11% of that entire corpus that you could have earned. So it's not minuscule in nature. And adding on to it, your that additional 10% of your corpus that you could have earned, you would have to stay invested for another year or so to get your return that would otherwise have matched. So just to get that 1.7 crores back, you'll have to stay invested for the 11th year, which would otherwise have you have gotten pretty much on the 10th year itself. So the magic of compounding, or should I say the curse of compounding in this sense, is that while it is truly powerful on one hand in terms of maximizing your returns, on the other hand, it amplifies your costs as well. So it basically ends up reducing your corpus in that sense.
Right. Mohit, when we compare index funds and active funds, which is a often compared, thing, how different are their costs, and how do those differences eventually show up in returns?
Of course, by and large, index funds would be comparatively cheaper to run, and active funds would be much more expensive because there is the investment manager cost as well. They have to hire better analysts, better fund managers, this and that. Honestly speaking, my understanding is it is not, costs are a very, very minor proportion of that thing. Uh, it's like, when we say missing the forest for the trees, we generally happily play Blinkit and Swiggy and Instamart pay higher fees because we want much more faster delivery. So I think cost, सबको पता है कि the cost is higher in a quick commerce versus a normal kirana ka dukan. My understanding is the cost is not a problem. The problem is, if you see, active funds go through a cycle of outperformance and underperformance, then outperformance versus underperformance. It is great. If you stayed for long run investments, if you stayed for 10, 20 years, the outperformance and underperformance would even out. However, almost two-thirds of the funds, and if you see as per SPIVA records and different things, almost quite a bit of number of active funds will be underperforming and outperforming all the bit of time. I think the last number was about 65-70% of them were underperforming. The problem is bulk of the AUM comes when you are outperforming. And they tend to go out when you're underperforming. So instead of buying when there's underperformance and selling when there's outperformance, most investors do the opposite. They will buy when a fund is at the top performing fund, and they will sell when the performance drops down. But it should be the other way around. When you go into an index fund, you are saying, forget about the cost. That is the difference. Fund managers justifying, say, in 10 years, I will beat the index. That is a different conversation. My sense is, do not go into the race where you know two-thirds of the time you will be wrong. If you go into that race, you will going to lose money because you are having a very wrong conversation.
Right, and that is the behavioral cost probably that you mentioned. Right. So Pranit, coming back to expense ratios, they are the number most investors they notice first. So could you break down what an expense ratio actually includes, and why do index funds have such a clear advantage there?
Absolutely. So the true breakup of a direct funds expense ratio can be a bit too technical for most people. So here's how I think about it. So one of the ways of understanding the expense ratio is to divide it into two components, right? One is the non-negotiable part. So this non-negotiable part is basically the cost that you would have to pay to anyone just to be in the market itself. This is the amount that even if you go out and buy a stock, you'll eventually have to pay. It's not like you're going to get the stock for free, right? It's a transaction cost, be it brokerage, be it exchange fees, be it custodian charges. It's pretty much, it's for the essentially, it's basically the unavoidable cost of being in the business of managing money. There's no way to escape it. And this is more or less what the index fund charge, plus the operating cost of fund management as well. But this is what they charge for an index fund. On the second part is what the the negotiable part of fund management. This is where the active fund add its own layer of costs in exchange for the promise of delivering higher returns. So as Mohit mentioned that there are certain phases where the fund outperforms, and those periods are practically chosen by the fund manager to indicate that these funds will give you higher returns, and this is why we charge a little bit higher. It covers the salaries of the fund managers, the analysts, all the data and research tool that they use to pick stocks, or even sometimes the marketing or distribution expenses. But that's pretty much the gist of it. And these costs are indicated that, okay, we'll give you a little extra in terms of returns, but we'll charge you a little extra. Right. So that is the entire selling point of the not negotiable part of expense ratio.
Right.
However, as Mohit rightly mentioned, is a surprising amount of data on it as well. And I'll mention some of it as well. The story isn't as rosy as it is being purported out to be. Within the large cap space, for instance, which is specifically one of those areas where active management is extremely struggling because of the higher efficiency of the market and everything. As of 2025, on an average, about 13 out of 27 active funds have managed to beat the BSE 100 TRI, which is the total return index, over a 5-year rolling period. Mid caps have done a little bit better. They have beaten about 16 of them have beaten out of the 24 of the active funds lot. But all of this story indicates that at the end of the day, it's a coin toss. It's hard to say, but for a longer period of time, over a 5-year period, even contention does come into play for active management. So the question practically writes itself. Does it make sense for an average investor to keep paying for that negotiable part of the expense ratio when even professionals and educated individuals are finding it really hard to justify it? And that's exactly where index funds have a particular edge over the other active funds counterpart. They don't try to, as Mohit rightly mentioned, they don't try to beat the market. They help you own it at a surprisingly lower cost of about 0.3%. And on the other hand, active funds, they charge about 0.8%. So they are sufficiently cheaper on the other hand.
Right, right.
Yeah.
So, Mohit, beyond the expense ratio, can you name what other costs an investor has to be aware of, like trading costs, taxes you mentioned, entry load, exit load? Can you please elaborate on that bit?
So I think primarily, see, what my understanding is, the bulk of the cost is, if you see about the returns perspective, 99% of long-term investors will create wealth because of staying invested in the market. Second will be the sector selection, whether it is a large cap or a mid cap or a small cap or a theme they are playing in. And third is the fund manager return, the extra alpha over an active fund versus an index fund. My sense is most fund managers, most investors would be rather better focused on the first and the second bet, whereas the equity time in the market and the category selection versus the third of the fund manager selection. Now, regarding the cost part, what you mentioned, the primary cost is, of course, management fees. Second is the capital gains when we sell a fund. I think that is the most of the two concerns. The capital gains, of course, I'm sure you know, equity may, it's after 1 year, 12.5% for most equity funds. And the management fees is pretty low. In fact, some index funds are there at about 0.1% even, or probably lower, and some are slightly higher versus an active fund of a larger expense. I think the major expense, which my understanding of investors should be completely focused on, is are you getting in at the right time or are you avoiding mistakes? Are you getting, I am seeing this left, right, and center as people are buying trending styles or trending themes, whether it is an index fund or an active fund, just because it has had massive outperformance. They are focusing on the third part, कौन सा fund select करना है. They're not spending enough time on the first and the second part. In the long run, this conversation of wants a fund is going to be the major problem. If you've got a theme or a trend which you bought probably 3 or 4 years down the line, if you see it right now, it has massively underperformed. That is the hidden cost of the iceberg which you are ignoring. But from the visible cost, it is management fees and capital gain taxes.
Pranit, John Bogle, he used to say costs matter. Mm, Can you explain what's the idea behind the cost matters hypothesis and what does the data tell us about it?
Absolutely. So John Bogle, as you mentioned, is often revered as the father of index investing. And his cost matter hypothesis really sits at the heart of index investing. Essentially, it's very simple, but at the same time, incredibly powerful for investors. The idea is pretty straightforward. In investing, your returns, the actual return that you will eventually earn, is equal to your fund's gross return, which is the pre-expense returns, minus the cost that you pay for it, which is the expense ratio. It sounds obvious, but it has longer run implications as well. Because while in the shorter run, markets are extremely volatile and hence unpredictable, Costs, on the other hand, are fixed. They are certain. It's eventually you'll either way, even if your fund underperforms or it outperforms, doesn't matter. You're gonna have to pay it. And that is what you can control. Otherwise, the market. You can't control the market, but you can control what you choose to pay. So if two investors were to start from the same starting point, right? Suppose me and you both start investing at the same time, and over a certain number of period of time, we earn the same market return. The one of us who pays the lower cost, the lower expense ratio, will eventually end up with more money, and that is it, pretty much it. The difference of the both of us will keep compounding year after year. I'll share some data on it as well. Here's how it plays out in the real world, especially within the large cap space. Take the current year, for example, for 2025. As of yesterday's closing, the Nifty 100 TRI is up about 6.3% for the year. The average large cap fund, the active large cap fund, meanwhile has delivered about 5-ish%. But if you adjust that for the expense ratio that they are charging, which is on an average about 0.9%, their gross returns, the pre-expense returns, shoot up to about 5.9%, which is very close to what that index was returning, about 6.3%. And index funds, on the other hand, returned about 6.2%. So very, very close. All that active management per se, or the post expenses that they everything charge and everything, they end up giving much lower returns than the low cost index fund, purely because of that expense that they are charging, or the 0.9% incremental that they are charging. So it helps to think, for an average investor, it helps to think like this: every percentage point that you pay in costs is a hurdle that your fund manager has to jump across. If your index fund has delivered about 12% and the active fund counterpart is charging 1%, the active fund would have to earn 13% just to break even at a gross level. And that was the entire insight of Bogle. Cost, while they don't eat up into your short-term returns, in the longer run, they compound against you. And over decades, that small gap, as I mentioned earlier, entirely makes all the difference. So choose a low cost index fund and you get all the structural advantage that one could get.
Right, but Mohit, what happens is, Pranit mentioned low cost as an advantage, but some investors, they still believe that low fees, that means low quality, or, you get what you pay for. So how would you respond to that?
Intuitively, from their perspective, I am completely agreeing with them because inherently, if you see uh, some of, if you see, if you're going by a car experience, if you have a luxury car, the price is higher and the value addition, perceived value addition is higher versus, of course, the cost part. And similarly for a lower, cheaper car. So intuitively, their frame of mind is there. I think I agree with them. But my understanding of the answer is this is not a problem of the expense ratios. If you see it from their perspective, most of these index funds are a fairly new thing. They probably have about 5 years or 7 years or maybe 8, 9 years of experience. Some funds will have a slightly longer experience, but I'm talking about the bulk of the funds. Intuitively, active funds have been there for the past 25, 30 years, and most of the long term investors have seen wealth grow. Why would they believe something which is based on logic and what they are seeing something versus on facts on their own portfolios? So
Right.
that is something which they will agree to it. I think over a long run period, once reasonable people see the logic behind it and experience the difference of cost in their own portfolio, they will see to it. This is the first part. Second part is most investors are greedy. And I completely okay with it. That is the reason why they've invested in equity. They feel कि भाई मैं आया ही हूँ active performance करने के लिए. Like I'm saying, majority of the people believe that they are pretty good looking. But that is the majority of the people, right? So that means that cannot be true. But everybody feels they are good looking. So similarly, everybody feels they will have the best fund selection and they will make the most return. That is why the fees is higher. So I think that is the second part of the question. And the third thing, and I have been most of the trending funds, if you see, they will outperform when they are They will get most of the money when it is outperforming. So when you see an example of an index, उसने 6% दिया है, but if you see bulk of the money has not gone into those underperforming large cap funds, it would have gone into the performing large cap funds, would have given 8 and 8.5%. Next year, when it would have underperformed, people will not remember it. People will redeem this and go on to the next outperforming fund, जो और अच्छा कर रहा है. So it's like a musical chair which is being played, and the investor is losing the money. So I think these are the three reasons why people are not looking at the cost and they believe that higher cost is equal to higher returns because they just have a different frame of mind.
So, finally, for someone who wants to keep investing costs as low as possible, what are the practical steps that they can take while choosing and managing index funds? Mohit?
I'll tell you something which I'm part of my IMB finance groups and other finance groups. I tell them one simple thing. If you are a do-it-yourself investor, then your target is to reduce the time, energy you're spending on your investments. Buy a simple index fund, a Nifty 500 index fund if you have from a long-term perspective, or if you want a specific large cap fund or a mid cap fund or a small cap fund. But by and large, a Nifty 500 index fund is buy it, fill it, forget it. Don't even think about it for the next 20 years. Do not focusing on musical chairs, just fill it, you're sorted in life.
Right. Well, thank you, gentlemen. That was a very insightful conversation. Thank you for joining in.
Thank you.
So if there's one clear takeaway from today's discussion, it's that costs, they aren't just numbers on a fact sheet. They compound just like the returns do. And over time, keeping those costs low, that can make all the difference between average results and real wealth creation. For anyone watching or listening, remember, you don't have to chase complexity. Sometimes the simplest, lowest cost path, it is the most powerful one. Thanks for tuning into The Index Investor. We'll be back soon with another conversation to help you invest smarter, stay disciplined, and build wealth the right way. Thank you.